Good morning, ladies and gentlemen. I hope you are enjoying this virtual meeting of steel industry professionals, and I truly cannot wait for the events like this one to return to the much-loved in-person format. Today, I will talk about how this past year, which delivered the biggest witnessed crisis on a global scale in most of our lifetimes, have affected Russian and the CIS steel industry, and what we may expect in the foreseeable future as a result of it. In the case of Russia and CIS, one thing we can see unequivocally is that prices of steel products would have to fall to the levels that they last were roughly in 2016 to bring them close to production cost level and bring about capacity reduction consideration. And I believe we are far from that, despite some recent wobbles in the market. In the last 20 years, Russia and the CIS steelmakers made truly giant leaps in modernization, synergetic growth, and streamlining their operations to build one of the world's lowest costing, high quality steel of any grade and sort. Decades of protectionism have tempered them to build their production with the mind for limited export opportunities, keen eye for changes in demand. And using abundant natural and financial resources, they build efficient, flexible, relatively low-cost production of quality product range. But they do not appear to be resting on their laurels. This month, at the annual St. Petersburg Economic Forum, almost every Russian steelmaker made a pledge to explore and implement green hydrogen-based steelmaking in the next 10 years. Financial support has been pledged by Russian banks, technical support by Russian and Western organizations. Companies have also been actively switching to captive power generation through recycling of industrial gases and running less and less mining and steelmaking capacities on coal and switching to gas as a more efficient and clean fuel instead. With this in mind, it is natural to see that Russian and CIS producers have managed the pandemic year extremely well, and that despite general upward raw material price trend, it concerns CIS producers less than the rest of the world, as they generate almost all of their raw materials domestically. Now, prices. The pandemic have catapulted steel prices to the levels never seen before, and Black Sea export market is not an exception. Several years of delayed demand generation, COVID-enforced production restrictions created a perfect conditions for this stratospheric rise once they were lifted and stimulus measures released. Chinese demand early in the pandemic supported CIS suppliers' export volumes whilst lengthening their lead times. Now, shortly about main products, and I will be happy to answer any of your questions during the Q&A, and I will just point out a few things in the remaining of this presentation. Now, if we look at hot-rolled coil and slab prices. In the past year, prices of hot-rolled coil have risen well beyond producers' best-case scenario in the second quarter of 2020. As an example, an average commercial grade HRC price projection was set at around 520, 540 FOB, and the worst case scenario at 400 to 420 FOB by the end of 2020 by one Russian steelmaker. In reality, those 6 months delivered HRC price growth to the level of 720 FOB Black Sea, mainly on Turkish hot-rolled coil boom, equally unexpected and powerful, which saw Turkish domestic HRC price at around $800 FOB by the end of December. Black Sea HRC prices have peaked at the end of May at $1,120 per ton, 3 times May 2020, 360 FOB Black Sea level. As Turkey remains Russia's and Ukraine's largest market for HRC and does not have sufficient supply of slab for all its HRC production, flat products price rise pushed slab prices up too. Although there has now been resistance in Turkey to pay over 950 CFR for CIS slab for almost 2 months, the sheer scope of the rise from around $320 per ton FOB in May 2020 to 950 FOB current offers, Turkey being not the only slab market for CIS, high prices and demand in the Western Hemisphere and Brazilian producers serving regional and US market predominantly, all keeping Black Sea slab prices at these high levels. In addition, of course, high capacity utilization volumes at CIS mills' Western rerolling enterprises keeps supply well regulated. Now, billet and pig iron prices. Recovery of construction markets everywhere has affected Black Sea billet prices equally positively. From 330 FOB in early April last year, the price rose to its highest of around $715, $720 FOB Black Sea in early May, settling currently at around 670 FOB, but looking to rise again as China began being interested in billet imports. Pig iron, on the other hand, is a trickier one because in supplier's view, it has all the elements of being a semi-finished product and have appropriate pricing structure, meaning primarily orientated by finished product price. But buyers do not always think so and continue to try and tie the price of pig iron to scrap, like it has been for decades when iron ore did not cost $220 CFR China. Regardless, from $270 FOB in early April, Black Sea pig iron export prices rose to $660 FOB in early May. They're now down to around $630, $640 FOB. And with US remaining the largest market, as an example, in April 2020, US domestic hot rolled strip price was around $595 per ton ex-works and on the descending curve. It touched 520 ex-works in the end of July, and it has been rising since to the current 1,775 ex-works as of Monday this week, more than tripling in price in the last year. Now, CIS pig iron suppliers are targeting higher prices, around 700 CFR NOLA at least, but without China buying, there appears to be enough pig iron coming on long-term contracts and from Brazil to the US, so CIS suppliers are still kept wanting. A few words on demand. The geography of supply has been altered dramatically in the past year for CIS suppliers. They sold more products to China than they sold in the last 10 years. They're selling more to the Western Hemisphere. They're selling more to Europe and much less to Middle East and North Africa. The latter region is still grappling with costs and domestic prices. The recovery has not been as dramatic as in other regions, but then the declines were also proportionately lower. Thank you very much for your attention. I will be happy to answer your questions during the Q&A, or you can contact me directly. Thank you.